Welcome back to the Joseph Carlson Show. We have an exciting episode to get into. First of all, we're going to be looking at the story fund. We haven't been looking at the performance of it for a while. I'll be giving a full update as well as a performance update on it against the S&P 500. But we also have a lot of news to get to. We have news just today. Breaking news that the new jobs report is out, and it was a blowout. Nearly double what the analysts, the professionals were expecting. Why are they so frequently wrong? And why does this economy never seem to enter into a recession? We'll be going over that. We have news that Netflix is raising prices again. Now, Netflix is one of my largest positions. A lot of people are going to be upset at the news that they're raising prices once again, and I want to explain in more detail what their specific plans are with this rumor. Now, while Netflix is raising prices, we have Tesla cutting prices yet again on the Model 3. The price drop has been dramatic over the past year, so I'll be looking into Tesla's strategy of doing continual price cuts. And then finally, we have a viral clip that we're going to be responding to. This is JP Morgan's Marko Kolanovic. He is a strategist at JP Morgan. And he's saying to brace for impact, that the market's going to go down 20% because of, yes, a recession. I'll be responding to this clip in this episode. So obviously we have a lot of fun stuff to get to in this episode. And if you like this type of content, you want to watch more of it, you can check out the Patreon membership. We literally have over 100 exclusive episodes, and I come out with new ones every single week. So you gain access to all this content when you join. And you gain access to a Discord community full of thousands of active investors, and you gain access to Qualtrim.com, which is the stock analysis tool I use. All of that when you join the Patreon membership. If you join today, just a friendly reminder, you get a free trial for the entire remainder of the month. So you have nothing to lose. I think you'll love it. That's why I offer a free trial. Now let's go ahead and jump in, and we'll first start off with a quick portfolio update. This is called the Story Fund. This is a portfolio that unfortunately I started in 2021. So I really picked the worst time to be starting a tech-focused portfolio. From 2021 until 2022, the end of it, tech stocks just plummeted. And so did my portfolio. At one point, this portfolio was in the red by around $30,000. And I was still showing it. That was embarrassing. I don't like coming on and making YouTube videos showing my portfolio in the red by 30 grand. Not something that I want to put out there, but just to be transparent, I continue to show it. And here we have a recovery. We're back almost into the green. Just a week ago, we were in the green. So there's a little bit of volatility, but that's what this is. It's now turned into a comeback story. Right now, we're trying to catch back up to the S&P 500. Now, if we look at this over time, I can show the graph here. This is what it looks like. This is the full story fund versus the S&P 500. And we have the story fund in blue, the S&P 500 in red. As you can see, when we started out here, it was tracking kind of in line with it. Then 2022 happened. We had interest rates going up. We had whatever happened with the economy. For some reason, investors were like, we want nothing to do with tech stocks anymore. So my portfolio plummeted. Now, that wasn't just tech stocks. I also made a couple really bad moves. I bought Netflix way too high, so that sold off big time. And then I also followed Charlie Munger into Alibaba, another big mistake. And I've promised myself I would never buy a company just because someone else notable bought it. And that's something I've kept to. The good moves that I did that helped recover this portfolio was I realigned my strategy. I focused on companies that were only free cash flow positive, that had very solid fundamentals. I got out of stocks like Alibaba and ones that I knew less about. And instead of selling out of Netflix at the bottom, similar to what Bill Ackman did, he bought it and sold it 3 months later at a super low price. I bought more Netflix towards the very bottom when it was trading at a 16 forward PE. Netflix has gone up over 100% since then. And then I also bought more Google at a low. I own $32,000 of Google. That one recovered. So you can see this rapid recovery year to date. We've made a lot of ground, and this really helped us get back in the game. So we've gone through a roller coaster ride here, and I think the portfolio is in much better shape now. Right now, the story fund is minus 1.6%. The S&P 500 is 7.9%. So we're about 10% away from the S&P 500. A year ago, we were 30% away. So again, we're closing the gap. We're having a comeback here, and I want to close in on this last 10%. If we can get above the S&P 500, I can get in that territory, then I can just focus on really making wise investment decisions and companies that will compound faster than SPY. But the goal here Don't be mistaken. The goal here is to beat the S&P 500. I'd like to have that done by 2026. Now, the way that I'm trying to accomplish this is by trimming off the fat in the market, the companies that are not going to really have outperformance, and focusing on companies that I think are the bellwethers, the ones that will really lead the market and push stocks higher. So here we have Amazon. Amazon has sold off over the past couple of years due to concerns about its overall profitability and if Amazon can be successful amongst a lot of competitors. The way that I look at it is Amazon is hiring an additional 250,000 employees for the holiday season. I don't think the company's worried about demand issues if they're hiring 250,000 employees. Amazon had a blowout quarter last quarter. They're doing fantastic. They have so many excellent properties. I think the Prime membership is incredible. The big risk right now, I think causing investors some concern, is the FTC. My opinion is I don't think that's going to break up Amazon. I think it might have a minor change in some rules with how they deal with third-party sellers, but I don't believe the FTC is going to have any dramatic impact on Amazon's future. Next up, we have Netflix. I made a large concentrated position into Netflix because I really love this company, both as a business, as the way they operate, their inherent operating leverage, the fact that they can grow into massive scale. Netflix is one of these companies that gains over 50% of their revenue outside of the US. So they're growing outside of the US across South America, Canada, Europe. They're growing through Asia. They're growing through India. They're growing through South Korea, all different parts of Asia. I really think their growth is incredible. Where they're growing the fastest right now, I believe, is South Korea. They really, the people there seem to really love their content, and Netflix knows that. They're making a lot of good South Korean content. I think these markets are huge. I think they'll continue to expand in different markets. And of course, they're going to be flexing their pricing power as well. Netflix is going to make $5 billion of free cash flow this year, putting them at a free cash flow yield of around 2.5%. That is good. That's about the same as Google in terms of free cash flow. So I think Netflix is in a very good position right now. Now, next up, we have Google. I also have around the same amount in Google. This one has been a big winner. Google is a bit of a gimme. It's a company you just invest in. It's cheap. It's a monopoly, does really well, and the profits roll in. We have $6,300 in gains in this company. Microsoft is one I've held for a while as well. $3,500 in the green on this one, $16,000 holding. S&P Global is a brand new holding in this portfolio, down about $700. $15,000 holding. Now, you might say this is a lot of big tech, but keep in mind, it's not just a big tech portfolio. We have no Tesla, we have no Nvidia, we have no Meta. So I'm being selective with the companies I'm investing in, and I've also overweighted companies like S&P Global and Netflix. So this is what the portfolio looks like as of right now. I think it's going to do really well, but keep in mind, this is a concentrated, highly volatile portfolio. It's not appropriate for most investors. And this also only makes up for part of my invested capital. The majority of my investments are in the passive income portfolio, which is a bit more diversified, has a bit, I think, more well-rounded of a strategy. But either way, I wanted to show you transparently what this portfolio is doing, and I think it's going to do really well in the future. Now let's go ahead and move on to the news here. We have the news that hiring's accelerating, 336,000 new jobs for September. They say this was the strongest gain since January and up sharply from prior months, upwardly revised to 227,000 gain. The Labor Department said on Friday, job growth was also stronger in July than previously estimated. So job growth all around has remained strong. Now, we're going to be talking about recessions later on in this episode. It seems like nobody can agree on the definition of a recession. In my opinion, when I think of recession, it has to have a couple key ingredients. It has to have people losing jobs. Unemployment rate has to go up. I don't think it's a recession if everyone's employed. What kind of recession is that? Anyone can find a job anytime and we're in a recession? That's just not recessionary to me. Recessions are when people have a tough time finding work. When unemployment goes up to 4%, to 5%, to 6%, that's a recession. When you have companies that are going bankrupt, that's part of a recession. They're saying we can't afford to hire anyone. So when there's people begging for work that can't find it, when there's lots of companies going out of business, and there's a slowing economy on top of that, to me, that's a real recession. When you have these type of part recessions, where the economy slows down a little bit, but people are still finding work when everyone's gainfully employed, It just doesn't sound too bad. It's odd that we continue to hire more and more people, even though we have all of these economic factors working against that. It defies expectations. They say that the higher interest rate, the elevated inflation, the resumption of student loan repayments, and rising oil prices all should mean that there's less hiring and more people pulling back on spending. But spending is increasing. People are still spending money. This is why it's very difficult, and I would say near impossible, to predict economic outcomes. When you think things should be slowing down, the economy just adds on a bunch of new jobs. Now, moving on, we get to some news that Netflix, and this is breaking news, Netflix is planning on increasing prices yet again. And I know a lot of people are very upset about this. I read the comments on Reddit and Twitter. I'm going to cancel my Netflix. I'm going to cancel my Netflix. No, you're not. That's really what this comes down to. Every time it's the same thing. Netflix has been increasing their prices every couple of years for the past 13 years. Now, if you were going to cancel, and by you I mean general people at large, just out there, if they're going to cancel their Netflix service, then how did Netflix go from 40 million subscribers 10 years ago to 244 million while raising prices the entire time? They've raised prices all the time, the entire time. They're still raising prices, and they're still gaining subscribers. That is overall the trend. So I know as a customer, this isn't fun to pay higher prices. I don't like it either. I'd rather have my Netflix stay the same price forever and just continually grow on the amount of content they create. But as an investor, I love it. I love this type of news as an investor. So as a customer, again, I agree. It's not fun to see prices raised on you. As an investor, these are the type of investments you want to own. Ones where they can raise prices and grow customer base at the same time. That is pricing power, which is the ability to raise prices while selling more stuff to more customers. When you can do both of that at the same time, raise prices and gain customers, that right there is the number one key to a very strong company. And Netflix has a demonstrated history of doing just that. Now, this price increase is just a rumor. We don't know anything about it. They basically say that the streaming service is in discussion of raising prices in several markets globally that will likely begin with the US and Canada, according to people familiar with the matter. That's a fancy way of saying this was leaked information. It couldn't be learned how much Netflix will raise prices or when it will actually happen. So we don't know how much or when, and Netflix declined to comment. So we basically know that Netflix is discussing potential price increases in the future. Big deal. This is what they've done literally for the past 13 years. We can even see this illustrated on a chart. Here's what the price was back in 2011. Right there, it was like $6, $7 a month. I remember way back in college when Netflix was $7 a month. Of course, the price has gone up over time. They're spending more on content. So this shouldn't necessarily be looked at as all a bad thing for the customer. A lot of these companies, like Hulu with Disney, Max, we have Peacock and Paramount, they're raising prices while spending less on content. Netflix at least is increasing their content budget because Netflix is the only one that's profitable out of all of these companies, aside from Apple. Disney makes profits with their parks, but their streaming service, Disney Plus, is not profitable. So Netflix actually offers more and more content for customers over time. I think the price increases are appropriate. I know there's going to be a million people complaining online about Netflix increasing prices. At the end of the day, most of you are going to continue paying for it because it's the best value proposition out there. So in my opinion, as an investor, I like seeing this news. But I agree it's a bit of a bummer when you're a consumer trying to save money. Now let's go ahead and move on to this Tesla news here. Tesla's a bit of a counterexample, and this highlights clearly why I don't invest in Tesla. The stock might do well. I'm not making any predictions on what direction the stock will go, but what I don't like to see is a company that's going to have lower margins with continual price cuts. We just have news today that Tesla cut prices on the Model 3 and the Model Y after the US car deliveries fell short. So meeting sales expectations difficult in this highly competitive industry. In order to meet their sales expectation of volume, they have to cut prices. In my definition, this is not pricing power. Pricing power is when you can increase prices without losing customers to competition. Tesla doesn't have that luxury. The reason why I believe is because while Netflix is like $7 and then their price increase will be $8, that's enough that people can pay for it. The difference between $7 to $8 is nothing. You can pay $8 a month. That's a price increase for Netflix. With Tesla, Their vehicles in the tens of thousands of dollars, buying these big vehicles, they're highly influenced by interest rates. People are not paying for these in cash. So when interest rates go up, the financing is so much more expensive for cars. They have to cut prices to make up for the rising interest rates. The demand goes down because people can no longer get affordable financing for their vehicles. So this leads to continual price cuts, and that's what we've seen with Tesla. They say this starting price for the Model 3 is listed at $38,990 on Tesla's website, down from $40,240 previously. So another $2,000 price cut. The Model 3 fell from $47,000 to $45,000. So again, they're chopping down the price, and this has been going on all year long. Now, Elon Musk has said that he wants to go for volume. He's not concerned about pricing, but I think that's a nice narrative for saying we can't continue charging what we were. And I think even Elon Musk has admitted that. Interest rates go up, they make the vehicles unaffordable, so you have to lower prices. With companies, again, like Netflix, if interest rates go up or down, people are going to be able to afford a Netflix subscription. So I like some aspects of companies like Netflix more than I do Tesla. Now, again, Tesla it's a company that always seems to do well. So the stock might continue to go up. That's fine with me. I have no FOMO. If Tesla stock continues to go to the moon, I will sleep well at night. All I'm doing is listing off my concerns, which I think pricing power is a big concern of mine. Now, moving on, we have this interview with Marko Kolanovic. He is a JP Morgan strategist, and the way that they introduce him, with the glowing terms that they introduce him with, let's just go through the introduction.
Well, the Institutional Investor Hall of Famer, known to move markets, is bracing for a sharp market pullback.
The Institutional Investor Hall of Famer. So this guy is a Hall of Famer, according to CNBC. Now, I disagree. I would not give him a Hall of Famer title, but that's how they're introducing him. Apparently, he's made some great calls in the past about the market. Let's go ahead and take a listen to what he has to say.
Marko, you, like so many people, started the year very bearish on stocks. You stuck with it pretty much. It's been not an easy ride, but at this point in time, you do see the pain coming.
Okay, so right off the bat, he started this year bearish on stocks. The S&P 500 is in the green. The NASDAQ is up huge this year, 30%. So when you're talking about these people in glowing terms, the Hall of Famers, and building them up like their advice is just, you just got to listen to what they have to say. You got to take into account that most of the time, what they end up doing, they highlight all the calls that they got right, and then they just somehow forget about the many ones that they got wrong, when overall, they're not very consistent. So he may have had some really good calls in the past, which got a lot of notoriety and a lot of attention. But this year, he entered the year bearish, and it's been a very bullish year. This is the recovery. This is where a lot of people have made their gains back. So if you stepped out of the market this year, you're in a bad situation. You missed out on a rally, and you don't know what to do. You're hoping that the market now goes back down so you can buy back in. That's what you're hoping for. But again, that's not a fun situation to be in. This is the problem with being a bear. You go out of the market will rally while you're out of it, and that's a problem because then you don't know when to get back in. And then bears almost become very pessimistic because they've missed out on the rally. They don't want to buy back in now. They want it to come back down to where they currently are sitting out. And I believe that's what happens even with good analysts. He was bearish the beginning of this year, and he's still bearish. Even despite what's going on with the economy, good jobs being gained, things moving forward, he's still sitting there wanting the market to trade down.
In time, you do see the pain coming.
No, so we had the price target 4,200, and sort of, in fairness, we thought that this is going to be a more volatile year, that we'll see more sort of chop. Instead, we got that summer rally, primarily driven by tech, which was sort of very painful. When that market came down sort of to our price target, and we remain somewhat negative still, so not necessarily calling for immediate sharp pullback, but we do think that recession will eventually happen. So sort of upside versus downside is stocks is not that great.
But this gets at the conversation we were just having in terms of timing. You can be an investor who believes that recession will hit, that there will be some sort of a landing, some sort of a recession, and that the pullback will come. But it's hard to position yourself at this point in time because the job market's still strong.
Job market is still strong, but you are starting to see stress in consumer. If you look at the sort of the delinquencies in the cards, in the auto loans, and basically, inflation is there, and rates are higher for longer. So this thing will eventually come, right? And so then we look at sort of upside versus downside, right? And
so let me pause it there. He says a recession will eventually come. Obviously, I agree with him here. A recession will always eventually come. That's such a broad statement. He doesn't say when it's going to come. He has no precise explanation of it, but he says around the corner someday it's going to come because higher interest rates. All right, so we have a recession coming in the future. What should investors do? The advice that we should become fearful and step out of the market is not the advice that Warren Buffett would give. He says that recessions are basically a little bump along a long road. You go through a recession, your companies do well, they'll get through it, and then you continue to invest. We've gone through many recessions. They've never been problematic for the long-term investor. So his stance that a recession's coming, therefore we should become afraid and be bearish and position our portfolio extremely defensively, I think is the wrong strategic stance. I'd much rather acknowledge that a recession's coming, but simply just continue to invest and know that that's a possibility. I think that's the better route to go. But he basically goes on to define this as a lopsided asymmetric bet, that there's far more downside than upside.
Could there be another 5, 6, 7% upside in equities? Of course, right? But if there is a downside, it could be 20% downside, right? And now you compare that to the cash, 5.5%, So now how much equity upside above 5.5%? So maybe 3, 4%, but then downside 20%, right? So that's that equity. Timing is very hard, right? And this year particularly, and we didn't get it timing good.
He missed out on 15%. All right, so if you look at the S&P 500, that's up 10%. If you look at the QQQ, that's up 30%. He missed out on that gain with his timing. So he's already out that money right now that is sitting on the sidelines. But now his argument is, right now, it's an asymmetric to the downside bet. There's only 5 to 7% upside in the market, but there's 20% downside. So it makes sense to be out of the market. That's literally what he's saying. Asymmetric bet to the downside. I disagree with this completely. I've heard this same type of logic so many times over the past 7 years. People saying that there's really no upside left in the market. It can't reasonably go much higher than 5% up, but it could drop 50%. I heard the same thing in March of 2020, when things looked so scary and so bad, when companies were shutting down, when earnings were going down dramatically for companies. They said there's no upside in this market. Look, we're already at a 25 forward PE. SPY's PE is already high. The market rallied 30% in months. People were proven wrong instantly. It made fools of some of the biggest and best analysts in the market. But this whole idea of putting a cap on market upside, saying it can only go up 7%, this is the same guy, the same logic that this year was saying to be bearish, and the market's up 10%.
That said, we still stick to that. It's not attractive. It's not exciting. There is an alternative. And recession, I'm not sure how we're going to avoid it if we stay at these level of interest rates. And the other thing is what's going to happen, right? So rates could actually go a little bit higher. I think the 13% might be, things would probably break a lot sooner than that happens. So I don't think it goes that high, but could go up a little bit more, which is already, I think, problematic for the multiple.
So again, another argument that the multiple doesn't make sense with the market right now. Now, I understand this is his job to go on TV, to market their macro analysis, but I think it's dangerous to listen to people like this. It causes people to sit out of the market. The best advice I think you'll get on these subjects comes from the legend Warren Buffett. He knows better than the analysts and strategists. Buy really good companies that will survive a recession. Continue buying them. If we have a recession and those companies trade down, that should be an exciting time where you buy more and more of great companies at really good prices, not something that's feared. If you play the game like that, I think you'll have a much better outcome than trying to time whether or not the market's going to go up year by year. It is impossible to time the market. He's living evidence of that. He is the Hall of Famer of market timing, a macro strategist giving broad calls on what the market's going to do. This year, he's been completely wrong. And for the record, last year, he was wrong as well. So we have the best people in the world that can't seem to get this right. The easier game is to buy into the market, hold long term. But that's going to be it for this episode. I hope you enjoyed, and I'll see you in the next one.